Welcome to Business Talk here on businesstech.co.za, where we navigate the winding highways and occasional potholes of South Africa's business landscape. Now, if insurance is the safety net of our modern economy, then today's guest is the person tasked with ensuring that the net is both sturdy and flexible enough to weather life's surprises. Joining me is Johan van Greuning, the Chief Executive of Standard Insurance Limited, which is a key player within Standard Bank's insurance and asset management arm, what I like to call the house of brands that puts Liberty, One Invest, Innate, and others under a very busy roof, shall we say. Johan is no stranger to the complexities of the insurance world, having spent nearly 3 decades at Standard Bank, where he's had roles that might require a separate insurance policy just for the job titles. He's been CFO for Wealth, to Chief Operating Officer of Personal and Corporate Wealth. Johan's journey has been one of strategy and numbers and a bit of weatherproofing as well, because as well as we'll soon discover, insurance today is as much about managing climate risks as it is about managing claims. So today we're going to be tackling everything from the ongoing hard insurance market to the opportunities and the challenges presented by Africa's very unique risk landscape. Johan, it's really good to have you on the show. And maybe we should just kick off on that hard market issue, because the insurance market has faced quite a prolonged, difficult market over the last 5 years, both locally and globally. What are the key factors that have contributed to this challenging period, and how has it shaped the way that Standard Insurance operates?
Thank you, Michael, and it's a great way to kick off the discussion. I think it's important to note that there are several factors that influence insurance, and particularly different products that is provided to different segments, and maybe core to one of the key discussion points in recent years, and quite a big contributing factor is the effect of climate and how that has resonated and found its way into our business. So the extent to which some will refer to them as catastrophe losses. So these are the elevated number of claims or severity of claims that is associated with more severe weather activity, and that has certainly placed pressure on that real cost of claims, and then that has resulted in us having to take a couple of extra steps. So to make sure that you treat clients fairly, we've had to change underwriting standards or improve and refine underwriting standards, and that is to make sure that you really understand the risk at point of take on, but also during a very prolonged period of having a client on your book, to understand how the risk associated to a particular client is changing and what measures need to be taken. And then there's the indirect implications. So insurers are as dependent of also buying additional cover. So we are not isolated in South Africa. So we are part of a global reinsurance community where we have to go and buy additional cover to protect the licenses as the regulator requires. And in recent years, we have certainly seen an increase in that real cost of reinsurance. Now, margin overall within short term is in ballpark ranges from, let's say, 3 to 6%, which leaves very little margin to absorb all these increased costs. And as a natural consequence, that leads to an increase in, let's call it, this prolonged hardening market where insurance premiums continue to be on the high side.
It's a very difficult balancing act, as you've just described, because on the one hand, you've got to ensure that the business is sustainable, and you need to increase, as those reinsurance rates increase because of climate change, but you also want to grow the pool and the size of the base, because, really that's how insurance works. So you've got to strike that balance to ensure that you can continue to offer something that's a compelling value proposition to the market. At least we're not Florida, where, given all the hurricanes over there, I'm hearing that getting mortgage insurance might be impossible in the next decade or two. And what would that do to the property market? But yeah, we do have our own climate-related issues, the floods in KZN, the wildfires down along the Cape Coast. Very, very difficult market. Now, if we look at insurance penetration, Africa's short-term insurance penetration remains, I think, relatively low compared with the rest of the world. What do we see in South Africa with regards to our penetration rate compared to other parts of the continent? And what do you see as the biggest barriers to helping increase demand in these developing markets?
Also a great question. And if we look at South Africa, the penetration, again, for different products would range in the low teens to early 20s. I think on aggregate, the penetration is in the region of just below 20%, which is rather low. It leaves quite a big proportion of the society that don't engage in formal insurance. And as you progress through the different parts of Africa, that number do reduce quite significantly to some areas where it could be as low as 1-2%. Um, um, so what are the barriers? What are the things that is impacting or preventing clients from coming in? At the forefront is definitely the level of disposable income. So if you have to prioritize about putting food on the table versus taking out protection, I think it's quite easy to understand what gets prioritized. Then there's perhaps a contributing factor, and that is just for consumers understanding insurance. So there's certainly a level of insurance literacy that is preventing some consumers to come into the fold. And then we have got a pretty high rate of employment in the informal formal sector. Inflation continues to plague many of the economies. And then I guess also just the work that in the insurance industry must do themselves to make sure that there's increased confidence in the insurance sector. These are the most key factors contributing to some of the barriers for entry.
On the other side of that, they say that every challenge presents an opportunity. So, where then do you see the opportunities for growth in the short term insurance sector across Africa?
Yeah, there's indeed many opportunities. I think we have seen in recent years that digital transformation has played a key role in how traditional insurance is taken to the market. And as we've seen in many other sectors, the adoption and transition into a bigger component of the business being conducted through digital means have certainly made it easier and for certain millennial groups who prefer to operate digitally. It has certainly started opening up that opportunity for us. Microinsurance is probably one of the areas that we're going to see a lot more development in years to come. And that is particularly to find solutions that move away from the full traditional comprehensive full cover, where you can make insurance solutions available to the more lower income groups of people. And then partnerships is certainly on the rise. So the participation and partnership between insurance companies, governments, and NGOs have seen across the world how that becomes beneficial, where the burden of insuring these more vulnerable communities can be shared and the problem tackled by a broader community. And then embedding of insurance is always very valuable because it gives you the opportunity of discussing and focusing on the client education at the time when certain financial products are taken up by consumers, to also talk about the real risks that the consumer will face, and almost making sure that short-term insurance is then offered, or at least firstly focus on the education part, and then to just highlight just the severe impact should you not insure. So we see that as an important, and particularly for insurers like ourselves that operate in a financial conglomerate, it gives us the ability to play that card very well to help with the education. So these solutions work pretty well.
And it's a really important component of the conversation we have around financial inclusion in South Africa and the broader African context. A lot of it does come with educating consumers about the value of protecting your assets, of protecting your income, of protecting your life, of protecting all of these things that you're working so hard for. And in so doing, we can make a dent in that kind of intergenerational poverty that seems to persist in Africa. If more and more people start taking out insurance and protecting these things and reducing the impact that it can have on the bottom line at the end of the day. Innovation is fascinating, though, because this is where we are seeing what they call insurtech, kind of fintech type players doing that micro insurance, maybe pay as you go type insurance. There are quite a few short term competitors entering in the market in South Africa. Have you seen this competition effectively reduce the insurance gap, or are we simply seeing new players in an old game? How do you see it unfolding?
Yeah, most certainly. We do work closely with some of the credit bureaus. And when we look at the high level information that comes out of that, it would suggest that all the competitors are competing within the pool for the same number of clients. So although there are new entrants, and what it certainly has done is it's provided the ability to access certain parts of the sector, which other players may not have traditionally been able to access. But the overall market seemed to be quite stable in terms of the overall pool. And particularly in the recent 2 or 3 years where the economy has been pretty tough, um, there's probably a net loss of consumers just because of affordability. So although many new players, I think what that does is it certainly drives competitiveness and forcing insurers to look at all avenues to improve their operations, to remain relevant in this bigger pool. But I think that there's a long way to go to find ways to bring solutions to those communities that are more vulnerable, as we've highlighted earlier in the discussion.
Yeah, and that's ultimately where we want to go to. Gigi Elcock, who understands that informal economy, whenever I see him present or I chat to him, I'm amazed at the size of the informal economy, and I think it gives us some inkling and insight into just to how resilient the South African economy is. And there's such scope for opportunity to design products for that market that may be better suited to your earlier point, the kind of micro insurance opportunity that you alluded to. Now, I want to come back to the impact of severe weather because I think it's probably one of the most difficult things now for the actuaries who sit and price these things and underwrite to understand, what's happening if 1 in 100 or 200 year events become 1 in 20 or 1 in 10 year events. That really changes the risk landscape, and we've seen this increase in severe weather events over the last 5 years. How has this affected the way that insurers are approaching their underwriting, and what do you see as the broader economic impact of uninsured losses from these events?
Michael, it certainly put all insurers on their toes when it comes to, so traditionally the setting of insurance premiums is all about modeling and predicting the expected outcomes for the base that you insure. And naturally, the partnership with key players through whom we place reinsurers with our reinsurance brokers. We run very advanced modeling techniques to validate our expected exposure. But when you bring it down to the client level, it's to make sure that you charge the right premium. So the introduction of techniques like using geocoding, for instance, has significantly started to shape the way that we think about risk and the pricing for risk, and that it becomes much more focused on the particular risk than just following a broad-based approach across a portfolio. And therefore, we can definitely see how that is emerging. So if you just take exposures across South Africa, You may stay in certain drier and more sunny parts that seldomly or see far less of these events compared to other regions that become a little bit more exposed to them. And it's just finding the right balance so that you don't penalize good risks for exposures or in areas where the exposures is more harsh. So the continuous refinement of
It's
these
really
models
interesting.
are very important, and we spent a considerable amount of time. And there are several, let's call it risk scores, attached to different type of perils, be it flood, be it wildfires, and maybe one of the best examples to show is you may, or many of the listeners may know, if you've traveled through Knysna, if you just consider how homes are distributed, you could either sit almost at sea level on riverbanks, you can sit up on the mountainside, and each one of those risks may be perceived to be the same if you just follow a broad-based approach. But yet the risks that each one of those properties face is completely different. So distinguishing and differentiating between that is important, and finding ways to then attribute, and that's certainly what our actuaries are continuously hard at work in, is to refine and make sure that you find an appropriate level. So if you just think of the impact, certainly given rise to some increased pricing naturally for risks that is higher. There are different ways. So in some respects, reducing cover for certain perils in conversation with clients can also be chosen. But part of that process sort of actually highlights the extent to which clients can also play a very active role in helping to mitigate and change the risk. And unless there's work together to find ways to reduce potential losses and exposures, you do get to a point where pricing and maybe underwriting and limiting a cover is not even an option, and that can result in uninsurability. But in our case, I think most of the impact in South Africa is just the big proportion, that 80% plus of clients who do not have insurance. And that obviously disrupts the economy. So in those localized areas, particularly if there's a large portion of underinsurance or no insurance, it takes longer for that community to recover. I think, though, one of the positive sides is that you'll say that's quite strange, but when these events take, there's actually very significant injection into the local economy, where you've got suppliers and builders and everybody that do get massive injections and having to rebuild those communities. And that's often got a very good big stimulus into the economy. Yeah, and then I think um, um, the big impact is obviously the impact on public funds. So on where the governments must step in, help restore the infrastructure. So yeah, it's a pretty big impact
Yeah,
when you're not
yeah.
insured.
Yeah, but interesting from that unintended consequence perspective of looking at the second order impact and how it does on the other side does stimulate in the rebuild. But there must be a way here, Johan, if we look at this becoming more frequent, and insurance companies are already at the coalface of seeing what happens because of climate change, of relooking at pricing and risk sharing and maybe even legislation around some kind of mandatory insurance cover to help increase the pools of cover to deal with these events and to help adapt to climate change. But from a cost perspective, how can the industry balance pricing to account for extreme weather events? And how do you see the costs being shared fairly among the consumer, the insurer, and the reinsurers?
maybe I've touched on one element of it, and this is this part of making sure that pricing is risk-based. So that's the most fairest way in making sure that pricing do follow a process where it is risk-based for a particular area, and that pricing then obviously considers how you can best absorb potential and expected losses, because it's not always just about events that have already taken place. So for long-term sustainability, you have to do this forward-looking view. So this forecasting is, when is the next 1 in 200 year? When is the next 1 in 50 year event taking place? And therefore, capital requirements for insurers are pretty stringent to make sure that we are there to show up when these events take place. And then the sharing of the cost is obviously, to the extent that we cover it ourselves, the biggest share of the loss is obviously carried by the individual who pays the premium. But then there's the role that the reinsurers play. And this brings in it's a balancing mechanism, because not every territory is impacted to the same extent at the same time. So reinsurers that offer cover for South Africa operates across the globe. So if you take the 2022 quite severe KZN flooding that took place, it was one of the most significant events in a couple of decades that hit South Africa. And if you look at the extent to which reinsurers participated in the losses, it was very significant, which made the impact for insurers, although still big, these losses were shared through international reinsurers who obviously have that balancing and different exposures in different regions from time to time. But that's also then important to notice that we are not isolated. So events that happen elsewhere in the world do play a role and have an impact on the overall global pricing to purchase cover.
I think that's a really good point to make. Often, consumers of insurance might not understand just how integrated the entire insurance ecosystem is globally because of the reinsurers having a global portfolio of risk. And so, how that then comes back to impact pricing locally. It was very interesting chatting to researchers at the University of KwaZulu-Natal following those floods. They did a study along with two universities in Europe, looking at sediment off the Durban coast and going back 6,000 years to the last warm age, and finding that hurricane type events were far more frequent when the oceans were slightly warmer back then. And they said no one paid attention to us apart from the actuaries at the big insurance companies who beat a path down to our door, because that's the kind of data that is going to help inform, how we approach the future. But looking ahead at the future, what do you identify as the most pressing risks facing the insurance industry? And back to the reinsurers, how can they play a more significant role in helping to alleviate these risks?
Yeah. Maybe something that we haven't spoken on is, if you look at the extent of technology advances, we have seen significant increase in cyber-related incidences. And it's a market that is not protected, or where covers is available, or covers available in South Africa, but it's generally offered by international players. So that's certainly an emerging, or a good example of an emerging risk. It's something that is on the rise, and where everybody is still finding their feet, because the ability to anticipate and quantify the impact of such losses are quite significantly. And to your question, is reinsurers play a very active role, because they see how the market is developing across the world, and key capabilities are being developed to provide cover to clients. Climate risk is most definitely something that continues to be on the rise, and I think that we are all aligned that the effort that goes in from all players in the space will have the desired impact of making sure that we can keep insurance alive, that we can find ways to overcome, but also that it starts to shape the way. And in some of the opening comments we spoke about, so and just the ability to get mortgage and insurance. I think for us in the bank, there's far bigger collaboration between ourselves and banking partners to really evaluate the risk. If you think of short term is pretty short in nature, if I can describe it. Consumers can move from 1 month to another. But if you take a mortgage, it's a long-term relationship that will stretch over 10, 15, 20, 30 years. And therefore, the financial institutions must take a view up front on whether a particular property in maybe a 100-year flood zone, what is the ability for insurance or for that property remaining insurable over a very prolonged period. Should anything happen and the client cannot source insurance, obviously there's financial implication, potentially also to the bank. So the collaboration between all parties to understand the risk is becoming increasingly important.
Yeah, fascinating. Johan, thank you so much for sharing your insights and for reminding us all why insurance is not just a safety net, but I think an essential pillar of resilience as we look to develop and grow the economy here in South Africa and in the broader African context as well. Thanks for your time.
Great. It was nice talking to you this morning. Have a great day and go well.